Ladies and gentlemen, it is all over for some people. It is only just beginning for other people. And we're talking about AMC. We're talking about investing in general. It's over for some people. Some people are commenting on videos with these kind of comments. It's kind of comical. So I did want to put this here in this video. It says, I was an ape. After I bought a put and be friendly with hedgies, I got 400% in 2 weeks. Seriously, get the fuck out of ape world. Now, for this guy, it's over for him. He's gonna miss out on the run, and we're gonna talk about when I think the run's gonna happen, why I'm even more bullish now than ever. If you've been following the channel for a while, you already know this. Over the last 6 months, I have been talking about this exact scenario, and it is literally playing out like clockwork, exactly how I've went over it. But we got some things to talk about, ladies and gentlemen. And before we get into all of that, I do want to just acknowledge some comments and kind of answer some of those questions. If you don't hop on the live streams, I'm really not able to go through and answer all the comments, but I do want to answer some of these right now because I think there's a lot of value in the answers that can be provided. So James Albert, shout out to you. Thank you for always commenting. I do recognize you all the time. And you've been a subscriber for about 4 months now. He says, my question is, how do you know how Wall Street thinks? Well, Wall Street is a mechanism for discounting future expected earnings, right? So what does that mean? That means that Wall Street doesn't care what is happening right now. They care about what is happening in the next 3 to 6 months. That's how Wall Street thinks, right? I've been investing for about 5 years now, nowhere near a expert. I haven't been in the markets 20 years, but I've been in the markets 5 years. I've seen times of extreme greed. I've seen a lot of catalysts over the last 5 years. This is the third market crash that I've been in, right? So when you've been doing it for so long, you know how Wall Street thinks. When things are great, they think they will be great forever. When things are bad, everybody thinks the financial system is ending, so to speak, right? People think it's never going to be good again. And people kind of don't like to look at the positives that are happening. They only look at the negatives. And that's really how Wall Street thinks. They think in 2-3 month terms, not, a year time frame or a 2-year time frame. That's why you're seeing so much negativity right now by individual investors, even hedge funds. Nobody wants to buy anything, even stocks that are extremely discounted, whereas a year ago it was a totally different scenario. So there is that. Here's another one that I think is very interesting. And people said, because he is a hedge fund and shorts AMC, and then trust me, bro, that's not what it comes down to. It's simple to see when you've been in the market so long how Wall Street thinks. It's goes without saying, if you've been in the markets for a long time, just stick around a while and you guys will learn how Wall Street thinks and processes information. Now, this is a very interesting comment as well. Actually came out about 30 minutes ago. He said, dude, I like your videos, but how do you explain the dump the day after the Fed meeting? Powell gave the market what they expected, half-point rate hike, even got the bonus of his lip service for the moment, saying 50 base points was not on the radar. The reaction during the presser made sense. So what happened the next day? Either the reaction during the meeting or S&P losing 4% the next day is sketchy. The jobs report certainly didn't cause that plunge. Just curious, it seems to me that either the market has no faith in Powell or market sentiment is pricing in what they think should be done as opposed to what has been done. I don't know how you can offset printing $6 trillion in 18 months with a total rate hike of 0.75% or 1%. Now, that's exactly right. This is a very thought out comment. So shout out to you. You obviously pay attention and you know what you're talking about here, right? But what happened the day after the Fed meeting and what has really caused this is a couple things. The Fed acknowledged China for the first time, saying China is a real risk to the economy. At the same time, Fed Jerome Powell actually ruled out 75 basis points, and a lot of people are saying that he should not have done that, that he needs to do whatever he needs to do to get inflation down as fast as possible. So those are two negative things. I think one of the biggest things that actually happened was Fed Jerome Powell came out, and I don't know if you guys caught this, but a lot of people are paying attention to this. Fed Jerome Powell said there's a really, really good chance of a soft or a soft-ish landing. I think that's a key, and I think the markets did not like that whatsoever. A soft-ish implies there will be a recession, but not a bad recession. So that's that. And the jobs report actually did play a big role, because the job market needs to come down and not be as hot. If the job market continues to stay super hot, then essentially the Fed has no choice but to keep acting super aggressive. Job market stays hot, inflation stays high. That's a recipe for much higher rates. And what is actually going on, and what caused that move, was the bond market. The bond market the next day is disagreed with the Fed, right? Fed meeting came out this day, bonds had sold off into it, and then the next day completely sold off as well. So the bond market is disagreeing, right? As soon as market opened, they sold off bonds. This was a very historical drop in bonds. Markets are selling bonds. They think the Fed is wrong, inflation is going to be higher, and the Fed is going to put the economy into a Fed-induced recession. And that's what is really driving the markets right now. It all comes down to bonds. If investors are selling bonds, which yield you over 3% now, and they are, I mean, you're not going to not get paid from the U.S. government. It's seen as the safest investment of all time. If you can get 3% right now, and they're still selling off bonds, big money, big investors, then why would you not sell off stocks? That's what is really happening right now. The bond market is leading the stock market. Like even JP Morgan, Morgan Stanley, Mike Wilson is saying, is that nobody knows what the right Fed approach is. And he goes on to say that the bond market is calling the tune here, said one strategist, this guy. So that's exactly what's happening. The bonds are moving the stock market. Now, when all things are said and done, the stock market has a lot of uncertainty off the table. I've said this in the last video, and I'll say it again. The Fed meeting, yes, well, there was not a great response from it, from markets. It's uncertainty taken off the table. Large tech earnings, like Apple, your largest companies in the world that control either 2 to 7% of the S&P per stock, those earnings are done. That's a lot of uncertainty off the table, because we know we're not going to potentially get another bad report for the next 3 months, but the markets are expecting that. So they're really baking in, and the markets are a forward-looking instrument. I use this analogy all the time on the live streams when people ask about this. You know, if there was an asteroid we knew with 100% certainty that was going to destroy Earth in the next 6 months, the stock market would drop 80% tomorrow. Right? Or 20% day after day after day after day, because nobody's going to put their money to work if 6 months from now the world's going to end. It does not matter what they report next quarter or the quarter after that, because the world would end, right? The markets are a forward-looking instrument. So that's why stocks are getting extremely discounted right now, because people are expecting the worst. And that's exactly where the money is ultimately made. And, you know, if you can weather the storm and be a net buyer of stocks right now, once that uncertainty and bad news is not as bad, or even if the bad news comes true, the markets have already priced it in. So typically you do tend to see bounces off of that. Now, if there was systemic risk here, if there was a 2008 kind of situation, this would be much different. But that's not exactly, you know, where we currently sit in the markets. Now, let's talk about this. Stocks could see more tumult next week, especially if bond yields continue to scream higher. And that's the main key. Are bond yields going to continue to climb? That's going to call the tune, essentially, as this strategist says. But it says the April Consumer Price Index is the big report in the week ahead, and economists expect to it to come in slightly below March's 8.5%, signaling inflation has peaked. Rates will remain an important factor for the stock market, and strategists say the course of the benchmark 10-year yield could determine the stock market's next moves. And let me just tell you, the bond yields look like a momentum stock, so they are going to chill out eventually. It's at pretty much 3.15%. It's been nothing but vertical, like nothing but vertical here. And once it refreshes, like you can see, it's straight up. So eventually when the bond yields do come down in a big way, which inevitably they will, if the inflation rate comes in better than expected and it's good, bonds will relax and people will, start to buy bonds, at least to some degree. Again, because one, it'll show that, hey, maybe getting a 3% yield isn't as bad after all if inflation will really come down to, 4% this year, 3% next year, right? Just throwing out numbers there. They would start to buy the bonds again. And that would definitely give room for the markets to rally. At the same time, it would say that the Fed maybe doesn't have to act as aggressively. And when you're priced for a worst case scenario like we are right now, it's very easy to see stocks actually go for parabolic runs when some of that bad news doesn't exactly come to light how the markets had expected it to. So that's going to be the main thing for next week, and we'll talk about exactly price predictions for AMC, all of that good stuff, everything that is coming out, all of the economic data, CPI reports, all of that. But when everything is said and done, let's revert back to what I said in the beginning. Some people just are not going to be able to handle the pain, and that's fine. Not everybody is built for the stock market. The stock market is the most ruthless place, non-violent place in the world. They don't care about anything else but making money and causing you pain when it comes down to it. These algorithms, they trade off of each other, and they essentially steal your money. I mean, if the algorithms want the stock market to go down, that's what's going to happen. If they want it to go up, that's what is going to happen. Now, for those of you guys that are in AMC, I just want to quickly reiterate and rehash what I've kind of been saying for a while now, and really over the last 6 months, I've been saying the same thing. Like, I probably sound like a broken record at this point, but I really don't care, because if even one more person hears the bullish thesis and can understand it, I think that's a win for the overall community. So essentially, the margin call situation. Everybody likes to say margin calls, and then they don't understand that margin calls have been happening, which is fine. I'm not trying to call anyone out here. Obviously, I'm not going to use any specific names, but people hear margin calls and expect stocks to go up, right? That's not what happens. Margin calls make stocks go down. Margin calls in a short squeeze scenario does not do anything. A margin call does not mean shorts have to cover. A margin call means you have to put money into your margin account or you will be liquidated, aka you'll have to cover on your short position. But if you get a margin call, that means absolutely nothing in essentially the prospects of covering on a short position. Now, when you see bonds that have been getting absolutely destroyed, bond investors are losing so much principal value. This is very, very historic. This is a fall or drop than the rise we've seen in 2020. To put that into comparison, everybody flooded into bonds in 2020 during the crash. Bonds spiked a lot from 136 to 175. Well, bonds have fallen essentially from 154, in December of 2021, all the way down to 113 as of Friday, closing at the low, a multi-year low. So what happens when a hedge fund gets margin called and they have a 60-40 portfolio, 60% stocks, 40% bonds? Well, the NASDAQ is down 23.29%. year to date. So since the start of the year, NASDAQ is down 23%. Hedge funds, they're getting clapped on stocks as well. The bond market is even worse off. I believe that's on like 35% year to date, somewhere around there, right? Corporate credit is rapidly dissipating. The private markets are getting much, much worse. So basically, liquidity everywhere is being sucked dry. So if you still have those same short positions, if AMC starts to rally, maybe because of their earnings coming on Monday, maybe because of their buying XYZ stock or whatever it is, whatever the catalyst is, but AMC, if it starts to rally, their principal amounts of their bonds, their principal amounts of their stocks is a lot less to service for those margin calls. So for comparison here, if a hedge fund had a short position, I'm not even going to name a number because it doesn't matter, but they got a margin call of $1 billion, right? Now their stocks 6 months ago, say they had $2 billion of collateral they could put up for stocks or for margin calls 6 months ago. Well, everything's gotten destroyed. Let's say it's down 50%. Now they only have $1 billion to put up for their margin call. Well, you're a lot closer now to seeing a margin call turning into a forced liquidation or forced covering of a short position. Closer now than you have been in the last year. So I don't see the disconnect why a lot of people are overly bearish on AMC now, when it's the exact opposite. You should actually be very, very bullish right now. So that's basically the thesis. This market environment is prime for short squeezes, but AMC has to have a catalyst. It will not squeeze for no reason. That's very important to know as well. So this is when the money will be made. This is the true test for anyone that is watching this video, for any investors out there. I mean, if you can continue to buy quality names, AMC for the short squeeze, and then more stable companies during this time, you will do great on the other side of this. This is not the end of the financial system. We will be fine. If CPI comes in great on Wednesday, the markets will rally 2 to 3%. That's almost a given fact. So that's pretty much it. That's pretty much it. Some people, it's all over for them. Some people, it's just the beginning. So hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Would love to hear from you guys. Make sure to join us on the live stream tomorrow in between 10 and 11 p.m. Eastern Standard Time. I would love to go over, more about how the markets are pricing things, how you kind of can learn to understand how Wall Street is thinking, and kind of help to make better decisions on what you think is going to happen next. I would love to go over that with you guys on the live stream a little bit more in depth, because obviously we did not cover everything here in this video. So happy Mother's Day, early Mother's Day to all the mothers out there, especially to you guys. Thank you guys for watching. If you guys want to come trade with us live in real time, link down below in the pinned comment. Get your free stocks as well. You guys know the deal with Moomoo, Weeble, and Public down below in the description. Thank you for watching, and I'll see you in the next one.